So we buy it not just young, but we buy it when no one wants it. So we get a bit of more of a squeeze there, right? Maybe 5-10%. And then we look at its peak time to be drunk, whether it's 10 years or 12 years, 15 years or whatever. And then we hold it and we hold it even longer. So we hold it when supply drops off a cliff and the market thinks there's no more left. And then we're like, boom. Then we re-release it back into the market.
Maxwell, welcome to the show today.
Thank you so much for having me, Garrett. Really happy to be here.
Yeah, so you have a really interesting asset class. We're talking about wine and whiskey today, which I'm pretty excited about. Talk to it. How did you get into this?
Great question. That's what everyone asks me. I finished university and went straight into finance and investments. I've always been in finance and investments. I worked for Australia's biggest bank, corporate banking, all that sort of stuff, and left that, hated it by the end of that, as most people do in their graduate jobs. And then started my own online business that was very much like a cash cow. So it was an online business coaching business. And what I quickly realized was that people were basically investing in us and the business was growing based on our personality. So not based on any assets in the business. So I was almost like a singer. I had to keep singing at the band, every week to keep the business going, the revenue coming in. So I was desperately looking to put my money somewhere, put my money to work, just sort of build like that solid asset base or recurring revenue or something, right? So I did what most people do, looked around and put a bit into property, get real estate in Australia, gave a little bit to my mum. And then I wanted an alternative, and wine and whiskey was always in the back of my head, because I just knew that there was something there that I didn't quite understand. And then I had a pretty profound experience one time in Chicago. So I was in Chicago catching up with one of my best friends at this really swanky bar. There's like acrobatics happening, and we're sitting there, we're drinking, and then the bartender says, what would you like to drink? And then I say, I would like to drink an old fashioned. And he says, okay, would you like it with bourbon or, single malt scotch? And I said, oh, single malt scotch, I don't really like bourbon. And then he said, great. So would you like Macallan 12 or Macallan 18? So for anyone listening, Macallan Scotch whiskey is a bit like the Ferrari of Scotch whiskeys, like sort of really famous, pretty high end. I said, you know what, I'm on holiday. Let's do the 18. So I drink the 18. Thought, wow, this is delicious, and never had an 18-year-old before. 18 means that it's 18 years old, right?
Mhm.
And then I give something to my friend, and then my friend drinks it, and he doesn't even like whiskey. And he's like, wow, this is amazing. And he drinks like half of it, drinks half of my drink. And then we're drinking it. And then I asked the bartender, how much was this again? And he says, 125. I said, no, 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 no. Not how much was the tab. How much is this drink? And he said, 125. And then I said, wow, shit. Well, I'm committed now. So, and I said, well, how much was the 12? And he said, 25. And I thought, wow. So what I know about these two drinks is that the 18 um, is the same liquid as a 12, the same production process, right? The only difference is that it's been sitting in a warehouse for 6 more years, just sitting there, like that's literally nothing else. And you're talking about a 500% increase in value in 6 years. So like a light bulb went off in my head, that there's really something here. And then I started with whiskey investing first, where you basically invest in cask that is then to be bottled, like a Macallan 18. And then I found wine investments, and then I decided to go all in and found the best operator, in my opinion, and then wanted to bring this to other parts of the world, like Australia. I knew Australia didn't have this yet. So, we're bringing this to America by way of the Delaware Investment Fund. That's what we do.
Wow. So how do you talk to me about like what is you said you found a good operator. What does that mean exactly? Is that somebody that's creating the actual whiskey? Is it somebody that's finding you the deals? Talk to me about that.
Yeah, yeah, great question. So, it's the fundamentals are very, very similar to property and real estate, really, really similar. So, in the wine whiskey investment world, where you want to be is you want to be in the top 1% of production. So the best of the best. So it's like in real estate, you want to have the best location. You know, if you have the best location, most things are sorted. So it's like how do you get access to the best location? You know, you either got to know someone, you got to pay a high price or whatever, or a little bit of everything. Right now, I'm the managing partner of the Oweno Wine and Whiskey Investments Fund. And Oweno, which is Greek for wine, that's where the name comes from, has been doing this for about 9 years now, where they've been basically getting direct access, you know, like wholesale access at wine whiskey investments. And we're only talking about bottles, not talking about buying shares in a company or anything like that, like the actual physical stock, just like how, you know, property real estate trusts would basically have deal with not shares in a building, but actual apartments, right? Apartments, units, condos, or whatever. What the company is really, really good at is finding overlooked and undervalued hidden gems. And that's because it has an amazing acquisition team, like a wine whiskey team. Like the wine whiskey team's about, you know, 5, 6 people, and they've got 80 years of experience. So what you need to understand about this industry is that all the best deals, you can't Google them. They're all off market, just like every deal. You know, all the best deals in real estate, the best deals in private market companies is all off market negotiated. And a lot of these relationships that give us visibility to these deals started 25 years ago with the team members that we have in the team. So I basically bought into just, you know, really, really solid existing infrastructure because I knew that that's not what my strength is. But my strength was, yeah, you know, being passionate about this, being on podcasts like this, and sharing this asset class with the broader market.
Very cool. So you get in with these off-market deals, and that could be like is that like a major label typically?
Yeah,
In
yeah.
tasks behind a major label. So it's not like some hidden thing that no one knows about. It's like you're getting in on the deals at the ground level and bringing investment capital to help their operations, essentially.
Exactly. The top
Yeah.
1%, top 1% of
Yeah.
producers, you know, and there's a specific reason for that. So top 1% of production in wine and whiskey is just like top 1% of real estate. It moves into like the luxury economy, the luxury
Hmm.
market. And that's where we want to be because, you know, you're extra non-correlated to the market at that point. These assets are non-correlated to the market anyway. You know, what happened last year in 2020? You know, the Bernard Arnault, who's the godfather of luxury and CEO of LVMH, leapfrogged Bezos and Musk to become the world's richest person in a contracted economy where the S&P is down, you know, whatever it was, 19% or whatever. That is where we want to be. So we want to just take the cherry of the cherry of the cherry on top of all those benefits and give that to our investors.
Wow. So what are the products do themselves? They just sit on a shelf, or how does it work exactly? Like where do these get distributed out? Who's buying them? Where you guys are able to profit from that?
Yeah, so think of it like this, right? They get produced from the vineyard or the produce or the distillery, you know, which is effectively like agriculture. So it's effectively like a farm. And then it gets bottled. And then that bottle has like a wholesale value. So, you know, what we're not doing is we're not buying bottles and barrels at the top price and hoping that they go up. We're not doing that. Just like in real estate, you know, you don't want to be doing that. What we do is think of like, imagine you've got like $100 bottle of wine or whiskey in front of you, and it's 10 years old. So it's taken 10 years to get to that point, that point of value. So we don't buy at that point, hope that it goes up even more. What we do is we look at it at a 10-year age, and we look to buy it basically 3, 4, 5 years younger at ideally 30 cents on the dollar. You know what I mean? So it's like when you go into real estate, you look at buying the land cheap and then adding the value
Mhm.
later. So the cool thing about this is that the value add that we do is just throwing it in a warehouse and just making sure the temperature is right, and the humidity and the lighting and that sort of thing. So we make sure that it's aged perfectly, and not just that, but it's got what we call provenance, which is basically authenticated documentation that it's that we can prove that it's been aged in the best conditions, so that whenever we go to then sell it to Michelin star restaurants or the Marriott Hotel or whatever, we can prove to them that it's at the best condition, the highest quality, the label's immaculate, so that, you know, their clients paying $10,000 a bottle of when it gets to their hotel room, enjoys a fantastic piece of wine or whiskey.
This is so cool. I'm involved in like basically I've hacked cars, like exotic cars before, and
Cool.
it's very
I don't think you should say
similar.
that. I don't think you should say that online.
No, I shouldn't say that online, the idea is essentially you figure out where the car is going, like as far as price, because those depreciate obviously fairly quickly, and you kind of find where they bottom out, and then you buy the car and you get like a mile allotment as to how many miles you can drive with it before it starts to lose its value based on kind of historicals around that type. Now, obviously, there's specs involved. There's the color, all that stuff. It all matters. The mileage, but similar in a sense that you guys are increasing value with your kind of in the luxury market, predicting out by looking at, hey, this one that's aged at this level is worth X. If we just buy it here and sit on it, it's going to be worth more later, which
Yeah.
which is pretty cool.
Yeah, so you've almost got like predictable value creation in
Yeah.
two components. The first component is you can't cheat time.
Right.
And if this is selling, if a 10-year-old selling this much today, if we just buy the vintage or the vintage, that's the only word for it, the vintage, 3, 4, 5 years earlier of the same production, and it was a similar year that year, you can almost see into the future, right? Because you can't cheat time, and there's intrinsic value creation in the maturity of the asset, which is just it's sitting in a warehouse.
Yeah. So when you're purchasing at the 30 cents on the dollar, so you're buying obviously the newer stuff. Are they selling to you at a discount on top of it, or is it just that's what it is at retail and it's going to go up from there?
Yeah, so we not yes, a 5-year-old of the same product, same production, will eventually get to the 10-year-old's value in terms of all that sort of stuff. But we want more. We want more alpha than that. We want to generate more alpha, more vig. We want more of an edge than just that. So what we also look at is we look at, yeah, betting big when inflation is high, because these assets usually do well in a high inflation environment because they're on the sell side of inflation, not on the buy side, right? So you want to be riding the inflation wave, not getting wiped out by it. And also what we do is obviously, we come in with economies of scale acquiring these assets. We want to make sure that every time we acquire a bunch of assets, we take a significant stake so we can almost influence, in many cases, price, volume, and depth. We have 55 exclusive agency agreements where we are the more or less the monopolistic controller of that stock going into the London UK market, which is the biggest stage in the world for wine and whiskey. Every producer wants to be there. So that's like being a real estate developer and controlling all the land in a certain suburb. So then you get to really, really juice as much, appreciation as you can, because you can release the stock slowly, control supply, demand, all that sort of stuff. And a big part of that, what allows you to do that, is to basically come in and buy it when no one wants it. So we buy it not just young, but we buy it when no one wants it. So we get a bit more of a squeeze there, right? Maybe 5-10%.
Mhm.
And then we look at its peak time to be drunk, whether it's 10 years or 12 years, 15 years or whatever, and then we hold it. And we hold it even longer. So we hold it when supply drops off a cliff and the market thinks there's no more left. And then we're like, boom. Then we re-release it back into the market and sell it back into the market at a premium when demand is high, supply is scarce, and there's even more market power at that point, because what happens is it takes 10 years to open one of these things, 10 seconds to open one and drink them. So, all we need to do, not all we need to do, I shouldn't say, that's not that easy, but what we keep an eye on is just consumption habits. If you want the price of a real estate house or a bottle of wine to double, either demand for it's got to double, twice as many people that want to buy it needs to increase, or supply needs to halve. So the cool thing about these assets is that they're consumable. So supply is designed to diminish. So as long as we keep an eye on those supply consumption habits, then we've got a pretty good finger on the pulse of value creation and appreciation and price.
Do you also know like all the inventory that exists for the most part for that, or is that's probably too difficult to track?
Yeah, so that's a double-edged sword, because there's an opportunity and a difficulty in that. The difficulty is that you can't really ever know. The opportunity is that you could almost bet that, when you go back to market, like let's say the price is at $100 and there was only about 10,000, 20,000, let's say 20,000 bottles of this made, in and amongst 100 million drinkers, right? So if you go back into the market with 100 bottles, you could pretty much bet that there's going to be less than what you think there is in the market, and 100 is enough to sort of move the needle. So if you increase the price of all of those 100 all at the same time and bring them back in, the market will more or less think that it's the price.
Mm.
And then whenever anyone is traded and one comes off the market, then you could almost itch the price up a little bit more and things like that. So it's a very, very inefficient, opaque market that has a lot of inefficiencies that, if you have the right infrastructure, you can leverage.
Yeah, with real estate, I mean, all we're really doing on the multifamily side of things is we're finding inefficiencies. So anything that, there's somebody that's operating their property poorly, that's always going to exist. And you can go and buy it at a discount because operations are difficult and not everybody can do them. So you're similarly you're just looking for that. And if no matter where the market's at, you can find some version of that, of course. So that's pretty interesting that you said that as well. I mean, this is really cool. So what kind of people invest into this, and what are like your normal returns?
Yeah, really good question. So we do get a lot of passion investors, people that love wine, like sommeliers, people that have worked in hospitality, and they've seen these bottles just be open night after night after night, weekend after weekend. So they're like, wow, of course, there's a predictable convergence to an increased value due to the scarcity, right? And we have a huge, like, remember, this is a pure investment class, it's alternative investment. It's non-correlated to the market. Returns, it's not hard to get double-digit returns. You don't always get that, but it's definitely not hard to do that if you know what you're doing. And so we do have a lot of sophisticated investors, like a lot. So when you go into the office and you speak to a lot of the guys there, and a lot of guys in the industry, and a lot of guys that have been around the industry, they're ex-bankers. The ex-bankers, ex-finance guys, ex-investment bankers, ex-traders, because they're like, wow, we've seen a lot, like especially a lot of the ex-trader guys, they've invested in corn, cannabis, gold, because they've seen stocks go up and down and all that sort of thing. And they're like, okay, I've got that part of my portfolio. Now here's my long-term, hopefully double-digit safety deposit part of my portfolio that sits outside the market in its own little lane, right? And so our returns for the last 4 years, these aren't returns for our fund. I'll just want to say that because our fund is brand new, but we're putting the exact same strategy into our fund. Our returns for the last 4 years have been 11%, 12%, 15%, 15% across just under 3,000 clients, 3,000 current active clients. So, across a huge portfolio of time, and also a huge portfolio of individual portfolios.
How long are people typically expected to have their funds into something like this to see the returns?
Yeah, so if you want to be in this game, you got to be, like a 5-year thinking person, 5 years plus, the more time, the better. So our investment fund is a 5-year lockup with everything out at the end. And that's the absolute shortest we can get it down, Those assets will start selling them down in years 4 to 5. And that takes an enormous, I can't tell you, we're talking about like 100,000 bottles, right? So we're talking about an enormous infrastructure machine to be able to move these assets. But it's worth it, because like I said, double-digit return non-correlated to the market.
So those returns, basically at the end, you're like, all right, we'll give you, after 5 years or more, say, all right, here you go. And then you get all your principal back plus whatever the amount, 11 to 15%. Are there any inherent tax benefits of this model or this fund or anything like that, or not so much?
No, not so much. Because it's put into a fund, it's just like any other fund. It becomes income, capital gains tax income, all that sort of stuff.
Yeah.
But if you are in the UK, this is almost a bit why the industry exists, the wine whiskey investment industry. So if you're in the UK, the United Kingdom, and in England especially, where a lot of people do this, when you buy wine, whiskey, or art, they're classified as wasting assets, which means that they're not up for any capital gains tax. So like the art investment world is bananas. It's absolute bananas in the United Kingdom. I know that Americans, Australians, and stuff have to pay capital gains tax on art, wine, and whiskey, but over there you don't. So what that means is that the market just absorbs a higher price. So it's a great market for guys like us, an Australian like me, an American like you, to have an operator like Oweno exiting your stock in that part of the world, because they're going to absorb a higher price and you get a higher return.
Wow. And there's a lot of demand out that way, right? So that those markets are some of the biggest.
Yeah, yeah, it's very mature. It's a very, very mature market.
Wow, that's amazing. So how much have you raised so far in general across all of your funds?
The
Would you?
the fund hasn't started yet in terms of the fund, but in terms of that portfolio product that I was talking
Mhm.
about, we have
Yeah.
about 83 million US under management right now, and that's like a revolving sort of line of credit.
Hmm.
Uh, so that goes up and down a little bit. But in terms of our fund and the Delaware fund and its interests, yeah, we've got an ex BlackRock Capital fund of funds looking to take a significant parcel. We've got a VC fund and a family office that manages, sort of leads investments for about 15 of their other family friends who wants to take a piece of obviously the investment, but also want to take a piece of the GP
Hmm.
as well, because they're like, wow, like we want a piece of long term. We could see this GP being really valuable and how this is being operated, that sort of thing. And we haven't even gone to market yet, so
Wow.
that's just from people talking about people, because yeah, it turns heads and it opens doors, this type of product.
What do you think is the biggest risk to this investment?
Yeah, so there's three main risks. The first risk is essentially market risk, which everyone should consider in every investment. So that basically happens if people stop drinking wine or whiskey. So that could happen. Has it ever happened before? Not really. People have been drinking wine, making it, trading it for about 2,000 years now. So it's got a longer track record than most asset classes. The next risk is yeah, pricing risk. In terms of pricing risk, you want to have that mitigated by working with producers who are price makers. That's why we stick to that top 1%. It's a bit like what I said with real estate. If you buy in a city like New York City or San Francisco, that type of thing, that's as much as you can do, right? Like, yes, the price could move up or down a little bit, but that's as much as you can do. And there's a fundamental, there's almost like a bottom edge bedrock of that. Hopefully, that price not going backwards. So we only like to deal with producers that are price makers. So basically, when they increase their price, or they're priced very well for their standard of quality, they've got a huge follower base. When we look at a producer, we even sometimes look at their balance sheet, to see, okay, where have they been spending their money? Like, yes, they make great wine and they've been doing that for 1,000 years, but where are they spending their money? Like one of the producers that we have invested in, they're in Napa. I think they're in Napa, and they've had a PE firm come in and invest 20 mil in the branding and the vineyard and the farm and everything. So it's like, well, if they got a PE firm backing them, helping them to take their brand and helping them to sell more internationally and that sort of thing, and really betting big on building this brand up, then why would we not piggyback off that? And then ride that appreciation for our investors. And the third risk is actually there's another one, which is breakages. So all of these assets that we have, whether they're in storage or in transport, sometimes they need refrigerated transport, and sometimes it's better for us to wait until winter to move them around the world, so we don't need to pay for refrigerated transport. So we got to consider that as well. We make sure that it's insured the whole way, so ensure that market price, independently valued and insured, just like real estate. And then the last one is counterfeit risk. So counterfeit risk is huge in the wine, whiskey, art industry, because think about it, right? It's a perfect crime. You're talking about, say, like a 20,000 bottle of wine. There's not many people in the world that have drunk this, especially someone that's buying it for the first time. And then usually when you buy it for the first time, you don't want to drink it. So you take it home and it sits like as like a trophy on your shelf for 5-10 years. And then maybe you open it one night when you're drunk, and usually five drinks in, by the time you open it, you don't remember what it tastes like. so they can give you anything, right? So that's a huge risk. So the industry is about $4 to $5 billion, the total industry that we invest in. So it's a very niche. It's a very sort of like rich niche. And particularly in Asia, there's about $3 billion of counterfeit stock estimated. No one really knows. So three out of five bottles, imagine that, 3 out of 5 bottles, say in a place like China, is fake. So So we saw that as a huge opportunity to like, look, let's be like one of the first wine and whiskey investment companies that puts a stamp, bang, 100% guaranteed and authentic. As long as it's come from us, but until it leaves our hands, we can't promise then. But if it's come from our hands up until this point, we're going to guarantee that it's authentic and it's real, and we're going to charge a premium for that because we're the only ones putting our hat and betting our name on that type of thing. So those are the risks. Yeah.
Wow. Yeah, I didn't even think about the counterfeit side of thing. That's kind of wild. I mean, makes sense. It's just a bottle, right? You could take the label, put something that looks a replica on, right? And just sell it. And who's going to know the difference? That is crazy. Maxwell, how can people get a hold of you if they want to reach out?
Yeah. So I can send some links that you can put in the show notes, things like that. But no one, I'm sure I don't read show notes. They're pretty hard to find, especially when you're driving. So my name is Maxwell Nee. Maxwell like Maxwell Smart, Nee as in November Echo Echo, NEE. I'm addicted to LinkedIn. So if you message me there, you'll pretty much get a response within 24 hours, maybe even 24 seconds. I'm the only Maxwell Nee on LinkedIn. I accept everyone. I post regularly. And the company is called ONO, which is spelt October, Echo, November, October, OENO group, or ONO Wine and Whiskey Investment. If you Google Wine and Whiskey Investment Fund and my name, you'll find me and you'll find us.
Great. Maxwell, thanks so much for joining us today.
Nice, my pleasure. Thank you so much, Garrett.